give me a shout and I can repeat. So last week I think I spoke too fast. Just to let you know that sorry, no worries. The contents of the seminars from this week 2 to week 9 will be examinable. And so, which means questions will derive from the 8 topics we are going to look at from this week until week 9. But it does not mean that it doesn't mean that another 2 seminars will be completely excluded. As you know, we did the introduction last week. There are basic points you need to know first. I'm not going to ask what is the security in the UK company, capital markets law. So you are not going to list. Here is the list provided by the FCA, and here are the different types of security. You are going to ask that kind of questions. For, of course, the introduction is also useful. And then, in terms of week 10, which is clearly excluded from the exam, is sustainable finance, because, as I said, we don't have enough time to get you into the details. So I will do a very brief introduction, and that sustainable finance will be excluded from the exam. But we will also do a brief review in week 10. You may ask me questions, and also I think what is important is what we are going to do in the week 8 seminars, we may call them substantive seminars. We look at a lot of what we can say the proposals for legal or regulatory reforms. They are not finalized rules. And if any piece of legislation or regulation is finalized by week 10, I'm going to update those with you. Okay. So, let's see what we will do in week 10. So week 10 is also important just to give you a brief review of the whole picture. Okay, so I hope this is clear. IPOs, and we'll also look at prospectus regulation, and we'll also see that we will look at listing rules, the regulatory framework of listing as well. That applies to IPOs, the traditional way we define IPOs, and prospectus will apply to IPOs as well. And we'll start with this because IPO is considered as the most important or the conventional way for a company which is at an advanced stage or at its later stage to get access to capital markets. What we are going to do today, so I will start by talking about what an IPO is, the general process of an IPO, the main players in the IPO process, perhaps in the first half of our seminar. And following my lecturing, what we're going to do is there is a background that in the past decade, especially after the financial crisis, we can see that the number of traditional IPOs on London Stock Exchange has been declining year by year, and the UK government has been very worried about this situation. And this is the background of the reforms. But before we look at the reforms, I'd like to get you to think about what factors have driven down the number of IPOs on London Stock Exchange, and this will be carried out through group discussions. So after I introduce the general picture of IPO, and you are going to discuss with your partners about different types of factors. So we better understand the entire background of the reforms of the listing regime as well as the prospectus regulation. And we will take a break. When we come back, we look at the reforms, completed reforms as well as the reforms which are being proposed. And we then also think about, because you then later know the background, what factors have driven down the the number of IPOs. Right now, companies, they are not very interested in getting listed on London Stock Exchange. Then we then look at the reforms, and you may consider whether they will be effective. And those are open questions for the second half of the seminar. And are we clear here? Okay, really. So please allow me to talk about IPOs briefly. So we know if we look at the literal meaning, initial public offering, it just means a company for the first time it issues its equity shares, pretty much equity shares to the public. If we follow this literal meaning, it may mean quite a different types of transactions or different types of offerings. But I believe that you have heard IPOs before, and conventionally we would regard an IPO identical to a company going public, a company getting listed on a stock exchange, right? So this is what we usually mean, and that is the narrower definition. But let's look at it in the broader sense. So it may mean just a company, either private or public, issues shares, equity shares to the public. Of course, you know that last week we talked about the company law definition of public offer, which excludes private companies from issuing shares to the public. That is the company law definition. I put it here, and I probably briefly touched on that there is also another definition under the prospectus regulation. So the company law defined public offer is different from the regulation. Here means prospectus regulation. Regulation defining the public offer. I will leave this question to the second half when we look at the prospectus and the regulation and the reform. A little bit confused, and later you will know the two different definitions. Here, if we follow the company law definition for the time being, if there is a company, public company issues shares to the public, this is an initial public offering in the broader sense. And you may also look at usually this company issues its shares to the public, and at the same time, all the shares can be traded on some sort of market trading venue, and this process is known as admission to trading. Conventionally, we know that a company will complete the two actions in one go together. New shares are issued to the public on the one hand, and these shares, and together with existing shares, sometimes it depends. New shares and existing shares together become transferable on a certain trading venue, very often the stock exchange, or sometimes AIM, we talk about AIM as well, the junior market, the junior market. Then, in fact, these are two separate or independent business activities. Of course, companies can choose to complete them in one go, but they may do them separately, which means this company only issues the equity shares to the public without having them admitted to trading. I only issue my shares to the public probably through a broker, an investment bank, but they will not be transferable on the trading venue. That's fine. Alternatively, if the company only has its existing shares admitted to trading, for example, on the stock exchange or on the junior market, without issuing new shares to the public, that's also fine. So a company can choose to do either a public offer or an admission to trading separately, despite that in practice they will do the two actions in one go. This will affect the application of prospectus regulation. We'll get back to it. So I want to talk about an IPO. It may usually mean that this company issues public shares. Issues the shares to the public. Sometimes, very often, it comes with the admission to trading. So here is the broader definition of an IPO. Then I just want to let you know that when a company only has its existing shares admitted to trading if this trading venue is a stock exchange, we call it a direct listing. So no new shares are issued to the public, and only existing shares will become tradable on the trading venue. And the difference is that when you issue new shares to the public, this is a primary market thing. So, and if we look at from the private law perspective, contract law perspective, this agreement is between the company as the issuer and the investors. Whereas if the existing shares are admitted to trading, it is not the issuance of new shares by the company, and then existing shareholders are allowed to sell their shares on the trading venue to incoming shareholders. So in contract, this is an agreement between the exiting shareholders and incoming shareholders. I hope this is clear. And these two actions can be done separately. So when it comes to what we usually mean, the definition of IPO, it's much narrower. It means the company going public. The company is getting listed on a national stock exchange. And this process means after this completion of an IPO, the narrower meaning of IPO, this company becomes a listed company. Its shares become listed stocks. And its shares are traded on the national stock exchange. So when we talk about IPO, which you may think identical to the process of listing, this process is actually a two-part process. In the legal context, listing means this company's shares, equity shares, are admitted to the official list managed by the public power, which is the FCA in the UK. And that this is for the regulatory purpose, because this company becomes a listed company. It is regulated by the FCA. And then transactions of its shares, this kinds of activities are also regulated by the FCA. Then let's do a comparison. If this company has its shares admitted to trading on AIM, Alternative Investment Market, which is the junior market. This market is for unlisted companies. Then those companies expect that their shares are tradable, are transferable, are liquid as well, but they are not listed companies and their shares are not listed stocks and they are not regulated by the FCA. Is this clear? Okay. So when we talk about listing means the stocks are admitted to the official list managed by the FCA. This company becomes a listed company regulated by the FCA, and this is the first part of the process. And together, the shares must be traded on the national stock exchange, not another trading venues. And I just want to let you know, it's a very simple point. So we usually refer to London Stock Exchange when we talk about a stock exchange. There is another one called Equities Stock Exchange, which is Equities Stock Exchange. This is quite small in size and very young. Never mind, it's also domiciled in the UK, so there are actually two. And so if a company is listed on Equities, and it needs to be regulated by the FCA as well. And okay, so different from the two separate and independent activities we just described before, when we talk about listing, it's a two-part process. Stocks are admitted to the official list. On the one hand, stocks are traded on the national stock market. On the other hand, and these two parts can't be separate. And the company, a listed company, needs to complete both parts as the process of listing. Is this clear? Okay. So just some backgrounds about listing, and then as a listed company, to complete the IPO in the narrower sense, it needs to comply with listing rules and then prospectus regulation. Later you will know that prospectus regulation applies to a wider range of situations, whereas listing rules only apply to the listing process. Then, in addition, London Stock Exchange may have additional rules regarding admission to trading, but very often the differences are rest with technical issues. General rules are consistent with the regulatory framework. Right, so let's have a look at the eligibility criteria applied to listing. I just want to let you know that when it comes to equity shares, here, when we talk about like listing rules, when we talk about prospectus regulation, they also apply to non-equity securities like bonds, investment funds as long as they will be traded on like stock exchanges. But I will focus, throughout our course as well, we will focus on equity shares because for companies, capital markets are most important. And for capital markets, companies are most important, especially their equity capital. So we will focus on equity shares, and you will also see that this round of reform, what is being reformed now is at the equity shares in commercial companies. Okay, so what we look at the eligibility criteria, they apply to equity shares in commercial companies. We don't look at the different requirements will apply to like bonds or investment funds. We just ignore them in our course. Okay, so here we go. We've got quite a lot of requirements, especially when it comes to the premium listing. Perhaps you've heard that companies may be listed companies may have like a premium listing or a standard listing. So these are two different segments of the London Stock Exchange for equity shares in commercial companies. And based on the name, probably you can tell that for premium listing, there will be companies will need to comply with stricter requirements. And for standard listing, many requirements are perhaps relaxed and perhaps just removed. And then when we talk about the reform, later you will know a very significant change the FCA is proposing is to combine the two together, to remove the division between the two. And we will get to that point and we will discuss why and whether this will work. I've listed here are actually this is the whole picture for premium listing. So here I think most the highest level requirements, but I just want to correct the error I made. So minimum market capitalization. Can I ask? Do you know what market capitalization is? Yes.
Total value of the shares?
Yes, the total value of outstanding shares. Just, if you have the share price for an existing listed company, if you have the total number of shares and the share price and just multiply them together, get the market capitalization. And there's a minimum threshold requirement. And this was just reformed 3 years ago. Which was increased from 7 million to 30 million. So I forgot to delete the old rule when I was updating the slide. So the minimum market capitalization MMC at 30 million pounds for the time being, and this also applies to standard listing. Another requirement is free float. Anybody knows free float means? Okay, Ruben.
What percentage of the share capital you're actually listing?
Yes. So the percentage, free float is a percentage. It means how much of your shares will be issued, will be held by public investors. And then there is a definition of the opposite of public investors, like the directors of the company, existing controlling shareholders who, like private equity funds who are subject to what we call lock-up period, which means they can't sell their shares for a certain period of time. Anyway, so public investors are just those we understand. And this threshold is only 10% And this was reduced from 25%. We will look at the reforms as well. And this also applies to standard listing. I assume that these are the two most important requirements for companies. And a sponsor, we'll get to the role of sponsor later. It only applies to premium listing, and then later we'll also look at those. So we will go through briefly here. Companies, if they want to get listed, want to have a premium listing, they will show historical information about their financial performance and their specific requirements, their earning records in the past 3 years, representing actually 75% of their business. Annual reports they need to provide. All of this should be included in the prospectus provided to the public. And also there are restrictions on, for example, if the company has a controlling shareholder, the controlling shareholder needs to issue an agreement to say we are not going to interfere with, generally speaking, we are not going to interfere with the operation or the independence of the issuing company. And when there are significant transactions or transactions with related parties like like directors, shareholder approval as needed, but all of these are proposed to be removed or relaxed by the FCA. So we will look at them in detail later, so not really now. And from here below, apart from annual reports, from here below, they do not apply to, usually they do not apply to standard listing. The only difference is that when it comes to historical financial information, prospectus regulation has additional requirements. So even if for the standard listing, companies need to provide some sort of financial information to comply with the prospectus regulation, but not the listing process. Okay. This is the current regulatory framework regarding listing. Here, I want you to think about the question. So I would like to introduce two different concepts. The first one is merit regulation. Merit regulation, briefly speaking, is the regulator will look at the quality or the performance, substantive performance or quality of this company, or what the qualifications or credentials and so on. And there are like thresholds on different aspects of like financial performance and so on. If the company does not meet the thresholds, this company will not be allowed to get listed. And this is merit regulation, or we could say merit regulation is made up of substantive rules. Whereas disclosure-based regulation means the regulator will not require the company to meet the thresholds of different types of like qualifications and so on. They just require, but also on a mandatory basis, they just require the company to provide these types of information. You must disclose these types of information to the public, to investors. Even if you haven't, the company has not made any profit in the past 3 years, never mind, but you need to let our investors know you have been struggling, for example, and then it's up to the investors based on their knowledge to determine whether to invest or not. And so of course, as you can see that in terms of disclosure-based regulation, the regulator's role is not that interventionist. Okay? I'd like to say that in the past few decades, especially in developed financial markets, you can see that it is a trend shifting from merit regulation to disclosure-based regulation. But I can't see that those jurisdictions, their national capital markets are purely merit-based, or those jurisdictions, especially the US and UK, they are purely disclosure-based. No, we would say that there is a sliding scale, and many jurisdictions are somewhere in between, whereas some are closer to disclosure-based and others are closer to merit-based. And then I would just want to let you think about. So based on these requirements here, which do you think are more merit-based, the specific rules, which are more disclosure-based? Which okay, sorry, Robert and Lois, which?
Do you want to go first? I think, sure. So probably something like the minimum market capitalization and the minimum free float rules are more merit regulation.
Yes.
So it's essentially saying that firms which are smaller than £30 million, although they may have potential and we don't want to put them onto public listing,
Yes.
probably for the purpose of protecting public, like lay investors.
Brilliant.
So rather than, because they're riskier, it's better that they are invested in privately by institutional investors probably. So for that purpose, you'd want that merit regulation if you're offering it to the general public.
You are absolutely right. First of all, MMCA is a merit regulatory rule, and the purpose is as well. It is to, later we look at the increase from 7 million to 30 million. The purpose is to protect public investors against manipulation and against the company's own business risk and so on. And I think 10% is as well. This is to, regardless of the effectiveness of the rule we'll talk about later, this is to ensure at least there are a portion of shares in the public hands, they are liquid and they can be easily transferred between different investors. Another, especially historical financial information, is apparently disclosure-based because the FCA does not say you must make profits in the past 3 years. And then, very good. And Ruben, do you want to?
Well, does the historical financial accounts not have a merit element to it? Because it says that you have to talk about whether the revenue earning record is supporting 75% of the company's business. Like that is a merit requirement.
Mix. It kind of like a mix. It forces you, for example, if the company has been making losses, even if the company, as long as the company provides at least 75% of the business, the 70% means, you have different segments or different subsidiaries, for example. You need to provide 75% of the whole business. You can't leave 25% of your business in private, the records. So, for example, you have like, let's say, 10 different subsidiaries. 2 of them are making losses. You can choose not to provide the earning records of those 2 subsidiaries, but the other 8 are making profits. You just provide those 8 subsidiaries records to the public, included in the prospectus. This is kind of like a tactic. So I would like to say it's a hybrid or kind of like a mixed rule. And of course, 75% is a threshold on the one hand, but on the other hand, there's some sort of discretion for you to determine which subsidiaries you would like to, the records you would like to include in the prospectus. And if all the 10 subsidiaries have been making losses, as long as you disclose them, that's absolutely fine from the regulatory perspective. Okay, then I think that perhaps annual half-year reports are this purely disclosure-based. Another question I would like to think about, despite the trend shifting from merit-based regulation to disclosure-based regulation, do you think, from regulators' perspective, no matter facilitating business or protecting investors, do you think we should focus only on, rely only on disclosure-based regulation? Do you see any merits in merit regulation? Or do you think I'm in favor of disclosure-based regulation? I think merit regulation is kind of like a barrier. How do you think? Okay, Louis?
I suppose, just thinking from the perspective of enabling business, the function that merit-based regulation might be able to provide possibly something like this is based on something I did in commercial last year on securities is signaling. So when you have a company or an investor that invests in a company, even if they have that disclosure, you might use, once that investor has invested and they've done their due diligence, other investors would then see that and go, oh, well, they've invested, so clearly they must be doing something right, and that facilitates more business to that company. And so I can understand with merit-based regulation from that perspective, I suppose it kind of does a similar function. So, well, if they've got minimum capitalization, even if you lowered it to say £5 million, there's at least something going on there. They've got some kind of funds which might make other investors go, well, we can see that they meet these minimum thresholds. Even if it's a high risk investment, we'll just do it anyway, because they've got something to back it up. It kind of reduces transaction costs in that way.
I see your point. First of all, what you said is like in capital markets, because especially today we got a large number of institutional professional investors, and we got professional, what we call securities analysts, and they have professional financial knowledge, and they have access to public information. Sometimes they also have access to private information, and they piece up all types of information together. They will make predictions, estimations about the business potential or performance. And then another institutional investors as well, they can tell, even if they don't do analysis themselves, they can tell whether the prediction is reliable or not, and they will follow. And for what we call like unsophisticated investors, instead of doing the research themselves, they just follow institutional investors. Next week, we're going to talk about the efficient capital market hypothesis, and those who are doing business, and then if the market is highly efficient, unsophisticated investors, what they need to rely on is just share price. They just look at share price. They don't need to do any research. And so if the market is efficient, against this background, of course, we can rely more on disclosures. But if the market is not that efficient, and the merit regulation may be needed, to some degree needed, especially one, disclosures are perhaps misleading or insufficient in those cases. And Ruben, do you want to add anything about it?
I mean, I was going to say that when you're issuing to retail investors, you do need to protect them because they are unsophisticated, and especially with the rise of passive investing in index funds, where actually the point is that sophisticated investors don't do the research and analyse and then make an assessment based on that. They essentially just invest in everything.
Okay, yeah.
Then disclosure requirements aren't as relevant because they don't look at the disclosure information anyway. They invest in everything. So then you do need some merit regulation, potentially to protect retail investors, even when they're using or when they're investing in sophisticated investors like asset managers.
That's brilliant, very brilliant. When we talk about investors in a very efficient market, investors only need to look at share price. That's ideal, but that's not realistic. And then there are different factors which may affect the judgments of retail investors as well as institutional investors. So some sort of merit regulation may be needed to protect them. Okay.
And then kind of running off that index fund point, I think merit regulation is also base standards from which an entire index can be evaluated by an investor. For instance, if NASDAQ didn't have a certain base standard of company, then why would you buy the whole index? And it assures investors that there are quality checks on companies listing.
Brilliant. So for the index fund issue, not quite sure whether everybody is clear about what an index fund is and how does an index fund work, because it invests. Okay, Eloy or Ruben, would you mind just introducing index fund briefly to the class?
Sure. Kind of the point of an index fund is that
What an index is, please? Please start from this one.
it's essentially just a large group of companies that fall into a particular category, and then generally people will invest in an entire index to follow the growth or the decline of that entire category. So whether that is the S&P 500, largest 500 companies in America, or NASDAQ, which is potentially where you invest in the entire exchange, or FTSE 100 again, the 100 largest companies in the UK. And you just invest by category rather than in individual stocks based on the merits of each company.
Brilliant, thank you very much. So an index like FTSE 350, the fund invests in all the companies included in the index. If the index is updated and their portfolio is updated as well, but this is a lazy investment strategy, and the fund manager will just purely track the index. They won't do any research themselves to look at the performance of different companies. On the contrary, that is called actively managed fund or stock pickers, because they will compare different companies and find the outperforming ones. So here is the difference. And there are a lot of impacts imposed by index funds. So little bit outside of the scope of our course anyway. So they do not rely on disclosures, and that means as a sophisticated investor cannot rely on their investment strategies or behaviors either, and that's why merit regulation may be needed to some degree. Later, when we talk about the reforms, you will see that it's a further shift towards disclosure-based regulation, and then later, when we think about whether there are any perils as to unsophisticated investors. Okay, brilliant. So, so let me go through quickly about sponsor. Sponsor is a requirement for the premium listing. I just want to clarify that very often people use sponsor and underwriter interchangeably, but underwriter, this is kind of like comes from this word itself derived from the commercial practice of like 300 or 400 years ago in England, but its meaning in IPO comes from the US law, and the traditional way to call this role is still sponsor. And this sponsor means that, if a company, issuing company, would like to get listed, it's necessary, as required by law, it's necessary for this company to appoint a sponsor. But then this sponsor's responsibilities arise from the law, not necessarily the contract of the issuing company. So as a sponsor, on the one hand, the sponsor needs to make sure that the issuing company and their directors are aware of different regulatory rules. They have procedures to comply with those. They will review and verify the information provided in the paperwork documents. These are the responsibilities to work with the issuing company. On the other hand, the sponsor also has responsibilities to notify the FCA whether they will give their own judgments whether this issuing company is eligible to be listed or not. They will issue an eligibility letter, and when there is any breach of law, they will also notify the FCA. So their responsibilities arise from what we say capital markets regulation, the public law domain, not necessarily from the private contract. The issue is that very often the sponsor is also the underwriter. If we talk about the underwriter in the commercial context, the underwriter's role is a little bit complex. If we look at the original meaning of underwriting, this person bears some sort of financial risk from the fee. And then in this context, a very important role of the underwriter is that if the newly issued shares will not be fully subscribed by public investors, the remaining shares will be subscribed by the underwriter. So the underwriter will ensure that all the shares in this IPO will be allotted. And that is kind of a guarantee for the company. If you would like to would like to raise, let's say, 10,000 pounds through this IPO, then with me, I'm going to acquire, as the underwriter, I'm going to acquire any remaining shares public investors are not interested in to ensure that you will get this amount of money. But very often, as the underwriter will subscribe to the shares at a lower price, discounted price, lower than the IPO price issued to public investors. And they will manage the whole process of IPO, like advertisement, marketing, and so on. So these are their roles in the commercial context, and these roles or duties or responsibilities arise from the contractual relationship between the issuing company and itself. So here is the difference between its role as a sponsor setting law and its role as an underwriter in the commercial context. Okay, so I hope are we clear here? Okay. Then this is pretty much about the commercial context. The due diligence is quite important, usually together with accountants and lawyers. Perhaps you have heard about like gatekeepers. Sponsors, we use traditional word, sponsors and gatekeepers, sponsors, underwriters, lawyers, and auditors. So they will review the documents and information and verify to confirm the authenticity of the information provided by the company. And their verification is important. Their endorsement, for example, is important for investors to make decisions because investors will think if those disclose or those types of information or this include here includes information provided in the prospectus for the first time and in the ongoing disclosures in like annual reports as well. And if those types of information are verified, investors tend to rely on them. So that's why we call them gatekeepers. It's a metaphor. If investors or if companies do not comply with regulations or capital markets rules, they will not allow the issuing companies to access the capital markets. They will not approve their, for example, financial statements and so on. Then investors may know, there may be a problem going on, we're not going to invest. So this is the gatekeeper role. I'm not quite sure whether you have heard of any discussions about gatekeeping role. There are a lot of disputes whether they can play an effective role in verifying and reviewing the authenticity of information, especially the most severe case is of the auditors, of the accounting firms. A lot of scandals going on. The most recent one is in Germany, but I'm not sure you've heard of Wirecard. Purely financial accounting scandal, and the accounting firm was, sorry, I can't remember. One of the big four, I can't remember which one, and for years didn't spot the problems, the fraudulent financial profit results. And the similar one, 2 decades ago in the US was Aaron, probably you have heard about that. So the essential problem is that if you look at their relationship, the company which is being audited, being verified, pays their fees for the auditors and for the lawyers. They are employed by the party which is being verified. So there is a conflict of interest. I need to stop here. It's another issue then. Okay, so let me now hand over this to you. Well, we may be running a little bit late here. Let me tell you the background briefly. If you look at the figure, so from 2015 to 2020, the number of IPOs on the stock exchange constituted 5%. This was reported in the Hill Review, and then I checked figure in 2023 last year, and it was even more disappointing. It's 3.5%. So apparently companies, including companies domiciled in the UK, are not very interested in London Stock Exchange. They may choose to get listed on New York Stock Exchange, NASDAQ, or they prefer to stay private. So here, I've hand over this to you. Please do discuss in groups, 4 or 5 people in a group. You assume that you are the directors of a large private company or an unlisted public company anyway. You would like to expand your business in each of these funds, but you have been hesitating whether you should get listed on London Stock Exchange or not. And I hope that you can explore different factors, taking into different factors into consideration, and later let the whole class know whether you final decision, would you like to get listed or not. Okay, so I've got a few slides here. Feel free to make reference to them or feel free to do your own research. Okay, so we have a group discussion, and together with the break, 10 minutes break, we'll come back and then we discuss all together. Okay, so yeah, let's start. And give me a shout if you need any help. 4 or 5 people together. I think it's fun as well. You guys perhaps work together. And if you want to add any background in your own scenario, like we have family business, feel free to do so.
So I guess we have to decide if we want to if we want to like stick to that, I guess it depends on what kind of company we are, but I guess
okay, we're not so much regulation. It's our goal to sell it, to actually sell it in product. Like, are we making money just raising capital? Or are we making money?
I think we can assume that if we are listing, then we are sufficiently far down the line.
It's not a
I feel like if we're talking about listing, we can potentially assume that we've gone through the venture capitalist stage. There's some kind of concept. They want out of the strategy, and their strategy is do we sell to PE or do we list?
Okay, so let's assume we've done like Series C, we've got a PE side of thing, the PE company wants us on this, so we are under pressure to get
yeah, I think about.
Is there any benefit to listing Bitcoin here out of the US other than the fact that it's less volatile, like, and you won't have that much activity under your line?
I don't really know what that
I think if you're an industrial, especially if you're a big base, then it can be beneficial for investors to go local investor because there is a risk of like relisting the US so much of it is the big one 6
but
so you can end up being
if you're new industrial, why would you want to go or
maybe a large portion of your or international, but you're probably better off listing there if you have international presence than if you're like a EU.
I think that's how if you're a new company with a Frankfurt or Amsterdam, if you have a US presence in the US, and you have an Asian presence, listed to more Hong Kong.
If you're a UK company, Asian, let's say like international presence,
properly spread out.
then let's say you're properly geographically distributed and you're in base commodities. Whenever I didn't mean to say base commodities. Finish me up. Yeah, then UK makes more sense.
Yeah, and I guess if your financial services potentially looking for
I think Glencore's listed on the other side. I'm pretty sure.
a lot of the commodities companies.
So yeah, if you're a commodities company, it makes sense.
Are here. Yeah, I guess that's the only time, and then you can literally say you're listed here because your peers are listed here, and it means that a large portion of investors who are looking to invest in more commodities companies look at the LSE first.
Long-term dividend paying.
Yeah, so I guess that's the only time that we would, but yeah, I think there's just a general liquidity problem.
Yeah, that's the main issue, right?
And index traders.
Also depends on how big your float is. Because if you're just looking to float a minimum requirement 10%, you might be able to do that in London. Rather than Nasdaq. Because again, you have like a stable investment that's going to drive your price. Like if you get a lot of their hats forever, I know some groups that you're so and then that's likely to experience cash decline as well.
Oh yeah, no shorting, or you can't short. It's very hard to short Australian securities and stuff.
I don't know about that, but if that is the case, then
Yeah, I mean there'll be lots of stuff here, like short series and bottom like
Yeah.
corporate maneuvers. I said it before.
and there's much bigger derivatives market in the US, like index funds, indexes. So a lot of people like offset their portfolio by buying short against the whole Nasdaq or like the whole S&P. And that's a very good way to hedge like
But I mean, if you're, I would assume that if you're listening for the first time, you're not going to listen straight into the S4.
Today, if you're 30 million, it makes no sense to no sense. Yeah.
It depends on how well you market for tech companies. They make like Jack and they still like go straight up. Remember like the blood machine, there's like a around like Elizabeth Holmes and get like
Yeah.
She made no money. But, like her first couple of years she was like shooting for S&P.
That was a special deal.
Yeah.
And then again, we have this question, so like these standards are very big. I mean, legally it's not, but mechanically to do with documents the same.
I think that's when you want to
Yeah, I guess it's much better. But I would say no.
It depends for SPAC. There's already been determined one of the
I think so. I think they're starting to
The blank check companies.
Yeah.
what other considerations would be?
You can't do that.
Why would you list publicly rather
I mean less filing requirements. Less paying.
Well, that's true, yeah.
I know one. Are you doing anything that's giving up to litigation? Monsanto being bought by it's cost 16 billion. Just to litigation.
Wait, and how does that change whether you list or not?
Well, Monsanto was back in the which was then acquired by which is German. And Previously, there was a lot of background this one quote that potentially had like such a carcinogenic effect around it, which was never, like it had been under 20, 30 years of being actually saying like, when you buy a book, it actually starts sounding like fast standards,
But from the people selling, the people exiting the Tasman's perspective,
oh yeah, true, actually, good point.
they're the ones who decide, do we sell privately or do we list? I feel like potentially you say there's a lot of regulation issues you look to sell privately because you need to get it done faster.
Yeah.
There's potentially less regulatory requirements because people are more happy to let PE funds make it go screw up. They are so like retail investors invest maybe I guess.
But I guess what's like cardinal investors, if you said you were
Because they have some dodgy practices.
Exactly. So
potentially, yeah, that's a reason not to list.
I don't know.
Yeah, I feel like that isn't as much why I would choose to list on what they talk about. I feel like that is very much just a one competition. Because the regulatory requirements are going to be so they might not be the same, but they're going to be a similar level of stringent nature because they're also retail investors and they're not quite processors.
Next generation I also like the revival.
So,
Guys, feel free to take a break and we will come back at 10:15. Or if you want to continue the discussion, yeah, feel free to do so as well.
It's like the same kind of
anyway, so yeah, how long was that?
So the amount of times it's like, I mean, that's a bit of everything. Like last time, like, so she's like, yeah, it was like, oh wow, from my contract. How are you?
There is so much story, but
Sorry.
yeah,
he was in a lot of things. You got back like we got well, yesterday I was gonna say what my grandpa was all so he was had like his yeah, so he's like he's still recovering now. He's working, but like the majority of it. Yeah. So like what happened was there was a car crash there, like 7 years as if like he crashed into the light, this wasn't directly like so yeah, he had it finally. He was in the hospital for a week and a half. Yeah, he didn't really have a holiday either. But yeah, he's finally coming back. He came back on Saturday. So like we were like added to it, that's what I was like, yeah, they're both a year long, so I have to start revising them now. Contracts is no, it's a lot more than I thought. So I got rejected by everything I've done. Like all of the books I had. And the last company, the last person I was so satisfied when you go like the they probably are the real things that these training and also so I'm like well, I'm working on my blog and Lewis application. And you're just talking about the differences between Scottish premiership and Belgium. You have to do it under 400.
I can skip most of the these people. So it's like you have to do seven courses.
What is it like?
I can skip. So I'm going to stay up here and do it online. Because AO's considerably further than I'm going to do it. And then I can probably work on go down to the history section.
So you won't be going
I'm staying for one more year. So you're doing PDL with nothing like that. You're going to apply during your PDL.
Markup, by the way.
Okay. You're in the post.
No, I'm in third year. What's your name?
I'm just going to put in another note, see what happens. I know that's like
Who else are left?
okay, so I've done there are a few that I haven't put one.
Paul's waiting. His girlfriend. They're doing well. Like, I did really well. We lived together for a while.
Coming up on tight there. Yeah, it was on the list. It was on my list and I didn't need to anymore. I was like,
Studies masters.
And she was like, yeah, it was
that was the thing. It was like, so I did US and then vaccine because I completely
Sorry guys, can I ask you for your viewers, is there some hidden or distinct names? This is nothing to do with the mark or the exam or the assessment. This is for the admin purpose to help the undergraduate office. I don't have a good memory just in case. I can't remember. Okay, thank Thank you very much, Dong. Give this to you. And just tick on your name. Find your name, tick on here, and then pass it to others. Do you need a pen? Yes, sir.
Any of the US ones, they really don't like to do a lot of this. So like they're supplying you.
Thank you very much.
Would you also potentially want to come across to work? Something like that. Especially once Sharon actually signs on.
Yeah, and it's going to. I like the idea of potentially being able to do it.
To get yourself onto the London events, but you're not big enough to get onto the US with them. Like if you come
Alright guys, shall we start? I believe you have made a decision for your company, right? Okay. Can I ask every group you ask someone has the right to let us know your decision on the one hand and how you considered this issue. Okay. Yeah. Shall we start from here, Ruben's team?
Well, I think we talked about a couple of different things. I think we kind of first talked about whether we should list full stop, and that was highly dependent on how big we are, what kind of company we are, potentially looking at the fact that private equity is slowing down a lot because of interest rates, whether that means that we're more likely to list, and then kind of talked about where we would list, and that was very much an economic discussion, and kind of I think the only reason that we came to why you would ever want to list in the UK is if you're a commodities company or a financial services company, one of the companies that there are a lot of listed on the LSE, and then you say, well, if we list with them, then we're at least in the eye of investors who go, we want a safe company, we'll look at the LSE, and then we're there. But that was kind of the only reason we could think of, because there's such market liquidity problems compared to the US, or even compared to Hong Kong. I think that's kind of it.
There was one more, which is, I believe there's less derivatives trading on the LSE than there is on US-based stock exchanges, and so you have more price stability. So especially if you're listing a small float, then maybe it's better to list in London so that it doesn't impact your market cap massively.
Brilliant. So you pretty much considered you would like to get listed on a stock exchange, but not necessarily London. So you are very determined to get listed instead of staying private. But you were considering which stock exchange to choose, right?
I think the question of whether you list is so dependent on what kind of company you are and how big you are. I think we also kind of said that staying private has a lot of benefits.
For example, in raw materials like metals, if you're a metals company, it may be beneficial depending on your practices to stay private.
Fantastic, very good. So usually for financial services or commercial companies, consumer-facing companies, for example, London may be a very good choice. Then for smaller caps, London may be a good choice as well to ensure the stability of price. For against the climate change regulation background, okay. So fossil fuel companies, for example, it's better for them to stay private given the heavy regulations. Okay, very good, very good. So I think you've considered a lot of different factors especially affecting the regulatory burdens the company will have to bear. Okay, and then how about high-tech companies? Do you think London will be a good choice?
Well, again, we did discuss that it kind of depends on the stage you're at as a tech company. So, because obviously, for example, as a tech company, a lot of your profits are very far down the line, you'll be focusing on, well, depending on what kind of tech you're looking at, but let's say, for example, like AI. At the minute, it's very hard to make a profit on it, and so a lot of your profits are way down the line, and so you'll need to be private for a long time in order to build any kind of cash or get any kind of financing. But if you're at the stage where, for example, you do have some kind of profit lined up, you have some kind of product that you'll be able to make money on, then again the decision kind of changes depending on what you're looking at. So for example, like if you've got product, again the benefits of staying private are you don't have the costs of the regulatory costs of doing that, and then also you gain greater control over your voting usually, or your investors will have a bit more. Your private investors will tend to be a bit more knowledgeable. You'll have their knowledge base, and so with something like AI, which might well become very heavily regulated, as some companies seem to be doing, being private might be more beneficial than going public. But if you were to go public, again, it depends on. I don't know where a lot of tech companies tend to list, but I'm guessing it's not London.
It's definitely not London. Also because for high-tech companies, their techniques may be confidential information, and they don't want to disclose various. It may be some inconsistent requirements, discrepancy between their own business plan and their public regulatory requirements. And also, high-tech companies, they are fund-based, heavily fund-based. Of course, now private equity funds now because the size is very big, and they usually are sufficient for high-tech companies, so they may prefer to stay private. On the other hand, if they need a lot of funds, they may go to the US because there they have a much larger investor base or investor community. Okay, so usually high-tech companies are not, well, London is not the first target of high-tech companies, even if for UK domiciled companies, they choose to get listed on the US. Various high-tech companies are the targets of financial regulators, the UK government. These companies are those that UK government would like to retain on the stock exchange. So let me ask another group, Jacob, your group, and Cameron. So I can't remember names. We've got three. I know we've got three Cameron here. Sorry, the girl, can I have your name? Rebecca. Rebecca. Okay. How about your group?
I think overall we felt that going public, there just weren't that many advantages. I suppose it's one of those things where it's like the burden of proof is kind of like, well, why would we go public? So we didn't really see that many reasons to want to do that. We could get most of the benefits from raising capital with private equity firms who might also be able to provide some like expertise on scaling companies and that kind of thing. And we also thought if we did want to get listed, then it probably wouldn't be on the London Stock Exchange because of the regulatory requirements, which is quite a lot of hoops to jump through.
Okay, brilliant. Private fund is enough, is sufficient for your company, whereas you don't really want to buy it regulatory burdens. Okay, very good, very good. Quite similar to Ruben's team as well. And that group as well. Can I have your name?
Third.
Sorry?
I'm the third.
Okay. Cameron and
Daniel.
Danny and
Crystal.
Crystal and
Victor.
Victor. Okay, yeah. How about you guys? You are here.
We felt sort of similar to the first group that.
You would say that, correct?
Yeah, it largely depended on what the size of our company aspirations that we had and stuff like that. But we did see probably the advantage of staying private.
Okay, let me ask, have you ever thought about One, if private equity funds are not enough, you want to grow to a very large size, what will they do?
So that was what we were saying, depending on sort of the
Is
size.
it possible that the private funds won't be enough for you guys?
Well, again, it's very relative, depending on the nature of the company. If you were a small startup company versus a big one, it depends what sector you're in as well, because when you're public, when you're listed publicly, you've got a lot more public scrutiny, and because of the volatility of the market, you're almost pursuing more short-term goals rather than long-term growth. So again, it matters on that nature. If we're the type of company that's going to be doing controversial things or have be in the media a lot, we also don't want to be publicly listed because that wouldn't get us the valuation we want. So there's a lot of things to consider, so I couldn't give a straight answer.
Fantastic, Dan, because once you get listed, when you have your shares in public hands, especially investment funds, they may push you to see short-term returns, especially hedge funds. And different from index funds, they don't care too much. They're not that involved in corporate governance, whereas hedge funds, they will launch different campaigns and they submit shareholder proposals to push the board to implement soft products which can generate profits quickly, but which may be detrimental to the long-term goal. However, another question is, private equity funds may want to exit as well. They may stay for a longer term, but usually within 10 years they want to exit. And what do you plan to do? Assuming that I'm a private equity fund, the investor, I think it's 10 years, I would like to exit. I also personally, please go public. I want to exit. I want to sell my shares. Another group can think together. There are other ways. It's not necessary to go public. You can find another private equity if that private equity fund would like to accept or to have if there are two different private equity funds. As the existing shareholder, I can transfer my shares to another private equity fund. Or if you can't convince me, there's still business potential to stay, I may invest more into the company. So there are different choices from the company. If you want to stay in private, you can seek additional private funding sources. Okay, brilliant, thank you. And this will Marco and the Chocolate, can I have your name? Great, please. Okay, okay. How about your decision?
It was very much very similar to everyone. It was weighing up, is it worth it? Because I was saying, I feel personally going public isn't great in the short run, but it can be in the long run. So like the process of it's quite brutal, it's quite expensive, and I think most IPOs, I could be wrong, most IPOs don't tend to do too well in terms of like the sort of returns and stuff when you're looking at it that way. So if we were to go for it, it would have to be with a long-term plan to raise money down the line, as opposed to that, because it would be, is it worth the imposition of other people on you? Because then, you know, when you're private, you can essentially do what you want, as long as it's legal. Whereas when you're public, you can't, because you've got all these people breathing down your neck. You have to have things approved. So we were really thinking about, is it worth it? So we don't know, we kind of opted for no, we'd stay private for now, but
okay.
I don't know, in the context it could be more useful to the public. Like you said, to get a huge influx of cash, it is probably the best way to go, but I'm not really too sure now.
You think it may be a long-term goal, but for the time being you want to stay in public? Okay, Marco.
One of my colleagues were talking about earlier, the only benefit, immediate benefit we see from going public is perhaps the public image that we're creating. I think perhaps the potential jump in share price that could happen if we were saying that, we're opening 10 new subsidiaries, we're going public now, look at us for, going public. It could, create some immediate effect, but the potential and the risks that are posed are still too high for us to choose that option.
Exactly, it's a trade-off. And I think corporate image may be a benefit, but may not be a very strong reason or rationale, especially if the private company is large enough or leading in that kind of like IPO, it's private, everyone knows, even if you say private, if you do very well in your own area and consumers they are committed to you, then they are loyal to you, and that I think the image of goodwill may also be very strong. Okay, very good. Oh, sorry. Thank you. Sorry for the noise. Did you hear me clearly? The last group. Okay, but 4 groups voting for the private, and how about you, Dan? Sorry, girls. Aria, and sorry, may I have your name? Renata.
Yeah.
And Sahara. Okay. Yep.
So majority of our discussion was focused towards listing on whether we list on the London versus the New York exchange.
Okay, yeah. So you will go public.
I think it's dependent on the discussion everyone else has. Like, you presumably make the decision to go public depending on your sector and size. But we decided that if we went public, we'd have the discussion on whether we list on the London versus the New York Stock Exchange.
And then how about your decision? New York Poland.
I think we considered the U.S. stock exchange as more prominent for a couple of reasons. The first is that there's a great trend, post-2008, there's a great trend towards deregulation in the United States, which makes it, insofar as the cost of regulation and regulatory compliance is quite high, it might be fiscally a better decision to turn to the States. Another thing that was brought up is that because of Brexit, there's a lot more regulatory uncertainty in the UK, especially with like the EU regimes and changing and whatnot. So it might be better to like turn towards a stock exchange where you had more regulatory confidence. And yeah, we discussed other things as well.
Yeah, I think it was a lot dependent, like you guys were talking about, on what sort of business you have. Like we were saying, if you're in tech, probably the US is better because most of that stuff is based there. But yeah, we mainly focused on why we wouldn't list in London.
Sorry, Ariane. Yeah, I got to an interpretation. Brilliant. I think this final group has particularly considered the differences between the UK and the US, London and New York, and apparently regulations there are relatively lax in New York. But here, as Alicia mentioned, that because of Brexit, perhaps there is some sort of uncertainty, and you think there might be stricter regulations going on. But actually, I think the UK government would like to make the best use of Brexit to reform listing regulation and the prospectus regulation. So we move on to that. Hopefully, we try to cover the most important issues here. Previously, before Brexit, listing rules, especially the prospectus regulation, they were formulated under the EU law framework, which were very strict. And a lot of the regulatory burdens imposed on issuing companies actually derive from EU legislation. And of course, Brexit gives an opportunity for the UK government to relax those requirements, and this is the background. Not only capital markets regulation, but also generally financial services and financial markets regulation. So just a little bit background. Not quite sure whether you know the Financial Services and Markets Act 2000, and that is the masterpiece of legislation in the UK considering financial markets regulation, and that piece of legislation was reformed last year, and the new one, 2023, came into force in August. But that is what we call primary legislation. It's the framework, and there are a number of secondary legislation which are being reformed, including what we'll talk about later. That is called the Public Offers and Admissions to Trading Regulations 2023. Whereas under the EU framework, it is called the Prospectus Regulation. They mean the same thing. So for brief, I would still call it the Prospectus Regulation. So in terms of Prospectus Regulation, previously or currently, the legislation is the EU prospectus regulation, and the directive has been implemented into FCA handbook, as you know. But after the reform, it will be a piece of secondary legislation by the HM Treasury. So this is the background. And then the listing rules are, well, rulemaking power is in the hands of the FCA. So the FCA has finished the first round of reform, and it is proposing the second round of reform. And this is a general picture. We will not touch on that. We will touch on another secondary legislation which was just reformed. That is short selling, and we'll talk about that in week 9. Also under the General Framework of Financial Services and Markets Act. There are quite a few beyond capital markets law, but within the financial regulatory framework. Okay, so yeah, here just want to let you know, I will also discuss here the first round of reform to the listing rules, the two different regulatory frameworks. Listing rules are managed by the FCA from the very beginning. Whereas prospectus regulations at a higher level. Of course, some sort of powers will be handed down to the FCA to make more technical based rules. Okay, so here we go. The reforms which have been completed include three most important ones. The first is about dual-class shares. Previously, dual-class shares were not allowed as to the premium listing, but dual-class shares are always available for a standard listing, and the reform was to introduce dual-class shares to premium listing with a lot of restrictions. So we are not going to talk about dual-class shares today, but in week 8, and we will know what kinds of restrictions have been imposed on dual-class shares in premium listing, and the FCA is proposing to further relax the restrictions. And we'll look at dual-class shares later. The other two we briefly touched on. One is to increase the MMC from 7 million to 30 million. Another one is to lower the free float from 25% to 10%. Both reforms, I think they were bold. The last one, some minor changes, they were just based on like some procedural rules. We will not look at that. So, and all the other reforms, we will look at them together. Well, the last one is in this week, and others in week 8. Okay, so let's focus on 2 reforms which have been completed. I think Louis touched on the impact of the increase in MMC. Here we go. Let's just get back to this point. What is the rationale from the regulator's perspective? Why did the FCA increase the MMC, minimum capital or minimum market capitalization? What is the impact on small cap companies? Currently, Lloyd.
They have to list on AIM or an alternative market table.
Yeah, we have no access to the London Stock Exchange. What is the rationale of the FCA to push forward the increase? Well, we know that against the background of the decline in IPOs, the FCA actually wants to encourage companies to get listed on the London Stock Exchange. This seems to be opposite to their intention and why. But they want to increase rather than decrease the MMC. Okay,
I think, as everyone kind of touched on, with the rise of private equity, nobody with a market capitalization of 7 million is listing anyway. So increasing it from 7 million to 30 million realistically doesn't make that much actual practical difference, because those companies aren't listing because they can still be fully financed privately. There's no need for them to list. And then kind of raising the bar, it sets a further guarantee of quality. It comes back to that merit standard thing of it's a bigger deal to be listed if it's slightly more difficult to be listed, and actually in practice it's not reducing IPOs because those companies probably aren't going public anyway.
Yes, I agree that there are, one we look at smaller caps, and there is a much smaller number of small cap companies going public. Despite that, actually there are relatively small cap companies. As you can see that the FCA, after the reform or after this rule came into force, the FCA gives those smaller companies 18 months to transfer to meet that, to meet this requirement, the threshold. But as you said, the essential reason as such, it's difficult for the small cap companies to meet the ongoing regulatory obligations, no matter merit-based or disclosure-based, and especially merit-based, because they need to ensure, like for example, corporate governance issues like independent directors. They may not always be able to comply with those requirements, which may be considered detrimental to investors. On the one hand, they can't meet regulatory requirements. On the other hand, the total capitalization is small, and that means their price is less stable. Price volatility is more severe as to these companies, and that means investors, when they purchase and sell, they may make a loss. And more seriously, if you consider this is a small cap, consider manipulation. We haven't talked about manipulation. Briefly speaking, manipulation is someone intentionally perhaps procures others, mislead other investors, procures others to invest, to purchase or sell the shares, or this person himself or herself sells or purchases a large number of the shares in this company to increase or decrease the price of the shares to an artificial level, which derives from the intrinsic value of the firm. And then when the total cap is small, it's easier to manipulate the price. Let's assume, hypothetically, that trading of 1% of the total shares will significantly affect the share price. If this company's cap is 1 billion, another one is 1 million, of course it's easier to manipulate the price of the small cap companies. And then the FCA argue that because they have first-hand evidence, usually suspected trading took place more often as to small cap companies' shares rather than large corporations' shares. And so they have taken into consideration all these factors. And I think the most important purpose is to protect investors and also to protect the companies as well. If you would like to stay, especially when private funds are adequate, you may stay private until your business is at a later, more mature stage. Okay, so then, however, the FCA has decided to lower the free float. We know the free float means the portion of shares in public hands. This is also a significant change from 25% to 10%. What may be the risks when this company, even if it has 1 billion equity shares, but only 10% are available, are transferable on the stock market? What may happen? What are potential risks? Think about it.
There could be some governance concerns because if only 10% is owned by public investors, then the governance of the company will be in the hands of private insiders.
Fantastic. Let's make an example for those who are doing company law. Do you know how much percent of the shareholders can call the general meeting? Sorry. Who are doing company law? How much? Do you know? Do you remember? General meeting is a corporate governance issue. That's 10%. 10%. So 10% means, if there is a controlling shareholder holding 90%, and there are 10% in the public hands, public investors, all of them must agree on the general meeting, then to submit a proposal to the board of directors. It's more difficult. But when it comes to 25%, let's consider the old rule, it's easier for not all of the public investors, but some of them, to call for the general meeting. And you may also need to consider the free rider problem when it comes to a large group of people. Okay, and this is about the corporate governance issue. Also, because let's consider liquidity on the market. When there are just 10% of the shares which are liquid, when you want to sell the shares, you may not be able to find a buyer immediately, and the liquidity is also a problem. And also, we will not touch on it in detail today, but next week. So, pricing, share price, has much to do with the liquidity of the shares. When there are a lot of transactions, share price will fluctuate accordingly. But if the shares are not that liquid, if investors are not able to sell or to purchase immediately, then the price information function of the capital markets will also be influenced. If you feel a little bit confused about this, never mind. When we talk about efficient capital markets hypothesis next week, you may have a clearer idea. So just remember that liquidity is a big issue when there are fewer shares in public hands, and that will also affect the correct pricing of the shares in the company, and corporate governance may also be an issue. So, as what I want to show you here after discussing the pros and cons of both reforms, as we can see, the FCA would like to encourage businesses to get listed on the stock exchange. On the one hand, it also considers how to protect the investors, but there is always a trade-off. It's very difficult to perfectly realize both goals. Okay, so then we move on to the proposed reforms. The most significant one is to merge the two, the premium listing and the standard listing together. Here, if we look at this proposed changes, because previously, at the beginning, I've listed a lot of requirements applying to premium listing, and many of them, which are particular for premium listing, will be removed. Then it's meaningless to keep the division between premium listing and standard listing. Because previously, because they are subject to quite different rules, then premium listing, based on the name, as you can see, they are subject to stricter requirements. They are considered to be perhaps better than the standard listing companies. After removing all of those requirements, they are closer. So the eligibility criteria applying to both segments are closer. Meaning is to keep them separate. Inside, merging them together will also benefit companies in standard listing, because currently only companies in premium listing can be included in an index. Okay, so that's about companies' images as well. Then, however, for the company, for example, we have a company which is planning to get listed with a standard listing. With this change, which may be implemented, if not this year, next year, then it has to comply with more requirements, because the FCA plans to return some requirements to the integrated category, which means previously standard listing did not need to comply some requirements, especially sponsor regime. So the sponsor, appointing a sponsor, this is only mandatory for premium listing, not standard listing. After the integration, no standard listing anymore. Any companies getting listed on the stock exchange need to appoint a sponsor. This is some sort of extra costs. Okay, and then here let's have a look at the removal or relaxation of substantive rules. We do not have time to go through one by one, but here it's just like you don't need to provide historical financial information, but the prospectus regulation may still require the company to provide. And I think another essential change will be shareholder approval for like significant transactions, related party transactions will not be needed. And as the controlling shareholder, you will not need to, it's not necessary, compulsory to issue an agreement to not to interfere. And these actions are considered pro controlling shareholder. Considering related party transactions, the controlling shareholder is insignificant. It's usually the common related party. Okay. Then, of course, this is to perhaps encourage controlling shareholders, especially founders, to have their businesses get listed on the stock exchange. What may be the perils? What may be the perils if all of these requirements are removed? Or do you think they will increase the risk? Anisha, how do you think? Sorry.
In terms of like whether this encourages shareholders to list on the stock exchange.
Sorry.
Like in terms of whether this increases the risk for companies, like listing on the stock exchange.
Yes.
I mean, even if like the criteria is a barrier to entry for companies to list, having that high barrier to entry is a good thing insofar as it just means that the companies that do list are better regulated and they have more internal compliance. So even if it increases the amount of companies on the stock exchange, it makes the market, or like makes the stock exchange much more volatile avenue of investment.
Brilliant. So you think there are still benefits and you make the internal compliance or company law requirements at the same time. Still there are directors' duties, for example, there are another requirements to prevent or to mitigate the risk to investors. Okay, and Mark, how do you think?
I was going to echo that, but also say that if you look at the Hill review, they seem quite reluctant and are quite conservative in their approach, and they're not willing to sacrifice investor protection, and they don't, comparing it to the alternative investment opportunities, they're not willing to do this race to the bottom, which is like sacrificing all the investor protection. So, continuing to protect and making the London market like a very high quality investor market is something that they would rather continue to focus on.
Brilliant. And I just want to add here as well, together with Marco and Anish's comments. Here, after removing these requirements, if we consider there may be some sort of merit-based element in these requirements, but after removing these compulsory requirements, the FCA still requires companies to disclose, for example, significant transactions, related party transactions. You don't need shareholder approval, but you need to disclose this transaction. And that is a shift, an evidence of shifting from merit to disclosure-based regulation. If information is provided to investors, what the company is doing is transparent, and then it's up to investors to judge whether this transaction is reasonable or not. If not, if there's any breach of directors' duties or any other perhaps contractual duties, and these investors, because the process is transparent, they may still protect themselves. Of course, there is a burden on investors themselves to do due diligence research when they decide to invest or when they decide to exit. Okay, so for an efficient and mature market, this will not pose a significant risk to investors. But it's of course pretty much it pretty much depends on the expertise or the quality of the investment community. Okay, are we clear here? Any question? Okay, then let's move on to prospectus regulation here. This is still ongoing, not updated yet. So for prospectus regulation, this applies to the major range of companies. So even for the unlisted company, as long as the responsibility to provide investors with the prospectus arises in two situations. One is there is a public offer. Another one is the shares of the company are admitted to trading on a regulated market, the stock exchange, not AIM. So if we get back to what we discussed at the very beginning, so making a public offer is a separate action, and admission to trading is another action. So here, if the company only issues shares to the public without admission to trading, a prospectus is needed. If the company has its shares admitted to trading on London Stock Exchange, a prospectus is needed. So we introduced the concept of direct listing. For the direct listing, a prospectus is still needed. The only situation where a prospectus is not needed is as the company are not going to issue any new shares to the public. I will have my shares admitted to trading on junior market, not a stock exchange. Okay. So if the admission to trading for the admission to trading to a junior market, that's fine. You don't need a prospectus. This is the current regulatory framework. Very complex because if I just had my shares admitted to trading on AIM, I don't need a prospectus. But later, I would like to issue new shares on AIM, the primary market to use the primary market function of AIM. I still need a prospectus, despite I submitted all the documents to AIM already, according to AIM's its own regulation. And also for a listed company, I have been listed. My company has been listed, and I've issued a prospectus together with my IPO, and I want to raise more funds. This is the secondary offering. A prospectus is still needed. There are exemptions. If you look at, according to the EU prospectus regulation, Article 1, there are exemptions. So here I also want to explain the difference between the company law definition and the prospectus definition. The company law definition focuses on public. Who are the public? And it explains that if you issue to a certain number of offerees, it's not a public offer, and so if you issue to related parties or employees, this is not a public offer. Whereas if you look at the definition, this definition is in the Financial Services and Markets Act 2000 Section 87. If you look at that, the focus is on whether there is an offer, regardless of whether who will be the offeree. So it means if there is a communication to any person and the information is adequate for that person to make an investment decision, this is an offer. So the focus is whether this is an offer in law. And so the prospectus regulation does not care to whom you will issue your shares. Then anybody may be the public. But the prospectus regulation sets exceptions. If the issuance is to less than 150%, if it's only to qualified investors like institutional investors, as there are exceptions, we do not expect to regard them as public offers. So here, the prospectus definition does not consider whether public or not. They just consider whether this is an offer, and just set exceptions under certain circumstances. And they do not exclude, most importantly, they do not exclude private companies from making public offers. Here is the problem. So, but it's still possible that an offer made by a private company is not a breach of company law, but still fall into the scope of prospectus regulation. So it's not a public offer under company law definition, but it is a public offer under the prospectus regulation. So that's possible. Okay. Then, because of the complex in the prospectus regulation and the regulator, not the regulator, the HM Treasury considers to remove some of the barriers. Especially, the most important one is to remove the subsection 2 of this criminal offense. So, if the company has its shares traded on no matter London Stock Exchange or M, this will no longer be without a prospectus. This will not be considered a criminal offense. But the first section will be retained. Sorry, let me go through quickly. And there are some further exemptions proposed by the FCA, which is to ensure that if the company you will have your shares admitted to trading no matter on the stock exchange or other trading venues, you don't need prospectus any longer to satisfy the public offer requirement. And also, this is particularly for unlisted companies. When you are making a public offer, at the same time you have your shares traded on AIMS, you just need to comply with AIMS regulatory requirements. You just provide the admission documents. You don't need to comply with the highest level requirements set in the prospectus regulation. So still there are some there's still some sort of uncertainty because the rules are not finalized. We have to stop here, and we perhaps cannot explain in more detail. And let's see whether I could give you some updates in week 10 to see whether these prospectus regulation will be finalized. Okay, if anything not clear about prospectus, please come to me. Thank you, guys.